Hi, hello everyone. Glad to see you all here and welcome. Thank you for joining us to this webinar about solar nature and energy efficiency as a new asset class for climate financing opportunities in Southeast Asia. I'm Loic, VP Investments at ENGIE Factory, and I'll be the moderator of today's discussion and also providing you with a little introduction about today's topic and the discussion. This talk is part of a series of events and publications undertaken by EarthVC, the Radical Funds, and ENGIE Factory. So I wanted first to tell you a bit more about them. On EarthVC side, they are a deep tech investor and using deep tech to decarbonize emerging Asia and reshape industries. They invest where science meets scale and they want to turn climate challenges into massive economic opportunity. The Radical Fund on its side is a member of the Utopia platform of funds. It's an early stage VC fund, and they invest in founders who are delivering climate resilience for Southeast Asia. And then ENGIE Factory is a leading venture studio building and investing in startups which accelerate the transition to a carbon neutral economy. We are part of ENGIE Group, which is a global leader in low carbon energy and services. And we use our corporate resources and we partner with founders to launch climate tech businesses. At the ENGIE Factory, we are entrepreneurs, operators, and investor portfolio ventures, especially on the financing and the fundraising side. So altogether, we are part of the Green Scale Up Collective, and we produce a collaborative content series spotlighting deep tech innovation and strategies to scale climate solution across Southeast Asia. Back in April, we hosted a webinar on that topic. And after a few months of research, insights gathered, we just launched the Green Scale Up Guidelines for Climate Deep Tech Commercialization in Southeast Asia, which is a step-by-step guide that has practical tools, it has framework, it includes founder first lessons to help in scaling climate tech across the region. And she was also here part of the chat here will share a link and would really want you to check it out, because what we really want is to support founders who propose scalable and profitable solutions to tackle climate change in the region. The topic of today is obviously very relevant to that because solar nature and energy efficiency are among the best levers to reduce carbon emissions, and they're all necessary if the world is to limit global warming to a viable level. I just wanted to cite, let's say, one metric more on the finance side. It's estimated that the region would need investments between 50 to 100 billion per year until 2030 to meet its climate objectives. By 2023, the amount was more around 15 billion per year. So you see how big the gap is. And so that's also the point of the discussion here is like, how can we make sure that enough capital is flowing to existing and new businesses in solar, nature, and energy efficiency? And so, yeah, to shed a light on this, I'm joined by 5 panelists that I'm happy to introduce. So in fact, I will ask them to introduce themselves. They are both on the investors and the venture side, all very deeply involved in the topic and very knowledgeable about it. So you'll be hearing them on the panel, and don't hesitate to drop questions in the chat as well. So maybe Marga, could I ask you maybe to introduce yourself first?
Yeah, sure. Hi, I'm Marga from Lendable. Lendable is a private credit platform. We look at supporting startups early stage to growth stage in both financial inclusion and decarbonization. Decarbonization for us is a bit broader than a typical credit fund. We look at energy transition, circular economy, carbon, sustainable agriculture. So, yeah.
Thanks, Marga. So you'll be more on the investor side, and so to follow on, maybe Jade, you could introduce yourself.
Yeah. Hi, I'm Jade from BII. BII, we're the British Development Finance Institution. So here in Singapore, we have a climate and infrastructure team covering Southeast Asia, which is a relatively new geography for us. Only since 2022, 2023, we started reinvesting in Southeast Asia, mostly through funds. So we are LPs in a few VC funds in the region. Wavemaker Impact is one, CZEF Climate Capital is one, Inciter as well. Other than that, more on my personal background, I have more of an infrastructure, renewable energy kind of a background, although I have some exposure to the VC nature space. So really looking forward to the conversation today.
Thanks. And now to go on maybe with the founders who joined us today. Yeah, maybe Reuben, you say well.
Thank you so much, Loic. Hi, everyone. Good to see everyone here today. My name is Reuben. I'm a co-founder at Arkadiah. We are a nature-based solutions provider, which means that we, on one business line that we have is to restore degraded lands. And then the other is we provide digital MRV to accurately measure and to report the restoration of these projects. And in order to give transparency, traceability to carbon sequestration. We operate globally and HQ in Singapore. Thank you.
Great, thanks. Thanks. Yeah, William, do you want to go next?
Sure, thank you. So I'm William. I'm the CEO and co-founder of Ampotech. We're a Singapore-based energy efficiency company that uses IoT and AI to improve the energy efficiency and operations of commercial and industrial properties. And I suppose relevant to today, we're also a portfolio company of Earth Ventures and CSEF. So we have some connections to a few of the other organizations hosting. Thanks.
Thanks, William. I think to finish the presentations with Bolong.
Hi everyone, this is Bolong here. I'm one of the co-founders of Get Solar. Now, Get Solar is a rent-to-own solar startup, essentially providing a no upfront cost, flat monthly fee model for homeowners as well as small business owners. We currently operate between Singapore and Malaysia, and I think maybe more relevant to this conversation today, one of the more interesting points about what we do is that unlike a lot of solar developers in the space, we've chosen to build in an off-balance sheet asset-light model for our rent-to-own solar plants, right? By partnering with asset investors to finance these projects. Happy to dive, a lot deeper into these in today's conversation.
Yeah, thanks, Bolong. Indeed, a nice feature of your business, and I believe also a discussion sometime in the markets and among investors on what's the best model and what's the most scalable. And we'll definitely get back to that one. So thanks a lot, everyone, for the intro. Now to give everybody a short overview of the discussion we'll have, we'll try to have three different parts if you want. First will be around more macro and policy picture in Southeast Asia, the aim being to understand what is the economic and regulatory environment and whether it's encouraging investments in these assets and how the situation about that is today. Second part is more around risk-return reality. So how is everyone faring in that? So from investor perspective or from a business perspective, and has there been already some learnings that we can share about that? And the idea then is to finish about, let's say, what's next, what's in the future. Are there creative financing opportunities that we can think of? Would be interesting to understand what the panelist has a view about that. The idea is to know if there are ways to deploy more capital and more quickly, because as just said, it's kind of dearly needed. So maybe to start on the first part on the macro environment policy, I want to start with a question that should also help to better define today's topic. And so yeah, for that, you've seen the title of the webinar, but to come back to that, I was wondering if we could consider that solar, nature, and energy efficiency was an asset class, and are they belonging all together in that asset class, and whether if it's in that asset class, can we say it is new or not? And I wanted to invite maybe first either Jade or Marga to maybe jump in to see from their perspective what they believe is the right definition.
Happy to, yeah, go ahead, Marga, if you have some thoughts, right?
That was really fast. Yeah, I think the way I view this is that yes, they all fall within this like sustainability, decarbonization, class of projects, and if broader like investors would just think of all of this as part of like the sustainable investing. But I guess the way I view these like three asset classes is really more around stage. So like solar, I mean, we've seen it in Southeast Asia, like boom in terms of CNI, like rooftop solar, as well as industrial, what do you call this, utility scale solar. So in that case, like those segments are quite mature. But if you go into residential, MSME, solar, as well as like NBS and anything that's energy efficiency, those are all kind of nascent segments that require a little more hand-holding from like the VCs, as well as more, I guess, patient capital from investors, because these are all segments that require, I guess, maybe more working capital, smaller ticket sizes, and those are, yeah, there's, I guess, a mismatch between like what's available for sustainability. There's a lot of funding out there, but for larger ticket sizes and more mature segments. But yeah, everything else like requires a bit more, I guess, focus and different types of like products that aren't necessarily easily available right now. Maybe Jade, you want to add to that?
Yeah,
Yeah,
Jade.
with you. Obviously, I think solar today is able to attract a lot more, a lot wider range of investors, from the least adventurous, let's say, to the most like VC type of investors. I think beyond the topic of what we're talking about, whether it's solar, nature, or else, to me, what I really see as a differentiating factor is what is the source of revenues, right? What is the profile of revenues? Because you could have a solar company, that whose job is to install solar panel, get long-term cash flows. And to me, that someone like me with an infra background will call it infra investment, which is a very, very different type of asset class than, let's say, I don't know, an IT or technology company that would have a product optimizing the solar profile of BESS, or sorry, storage, or solar and storage kind of installations, which would have maybe more of a riskier technology-based kind of a profile, which someone like me who is more used to stable cash flows long term won't really understand. So I think beyond the topic of nature, solar, and so on, you also have to look at what's the stage of the company within the value chain? How do they make their money? So I think there was an interesting comment from Bolong before of how he had to switch from asset light to asset heavy, or the opposite. And I think there was also a comment or a discussion we've had previously with William from Ampotech, who also mentioned that there's different ways of going about the same business, and those in themselves are different asset classes. So yeah, maybe that's a bit detailed, but I thought it's an interesting distinction to make.
No, I think it's quite insightful. So I hear from Marga mainly about the stage of, obviously, different technologies and types require different levels of knowledge. One is a bit newer, then more handholding is required. While on Jade's side, maybe, and as an investor, depending also whether it's on the lending side or equity side, it's about cash flow generation, obviously, and that's the case for any type of business, of course. But when it's very early stage and you're an equity investor, of course, the positive free cash flows might be less easy to estimate. And maybe for that, I'd like to turn to the founders and say that and ask whether on your side, then you're also targeting specific types of investors, or like, do you really differentiate them, or do you believe that whenever you're going to fundraise, you can basically go all around and see them? I mean, of course, taking into account your stage of maturity, whether it's early stage.
Well, I think
Happy
I
to jump in
can.
on that question. Oh, go
Oh
for it,
yeah, go.
William.
No, no, go ahead,
No, you
please.
go for it. Okay, I'll go. Quick one, and I'll hand the mic over to you. On our end, we're very early stage. We raised a seed stage last year, and then just about to close Series A. And the way that we look at the cap table is there's a pool of capital for the holdco, i.e., for the startup, to develop our technologies and the team and to do the hiring. And then there is the project level financing, which then splits into also two buckets. One is an earlier stage, which funds the project design and development, and then subsequently a mid stage where it's a investor that would just take the fund the implementation of it. A subset of that could also be an off-taker, in which then the investor for the implementation phase would have a higher level of confidence. And I found that to be an important way to think about the capital stack, because some companies use the equity on the whole core to start doing infra-like or long gestation projects, which then results in a really mismatch of expectations and causes tremendous stress either on the startup side or on the investor side. And that said, it's easier said than done. It literally means that you have to tap three capital pools for the funding of all the projects. And it's, fundraising is tough, and it's even tougher now in this environment. It's literally playing on hard mode times three. Over to you, William.
I think
Totally.
that's a really important comment. So this is a little bit similar to what we've seen, because we closed a funding round in January this year. Not an easy time to be going through that. And there was a big difference between the types of investors that were more on the venture side that we had raised from in prior funding rounds versus CSEF, who we raised from in the most recent round, which is much more, I would say, coming from sort of an infrastructure and energy background. So for us, we felt like for us to really take the next step, we need to be able to access more of the project and asset type of financing and kind of tap into that type of investor, because the traditional sort of venture mindset, I think, is challenging at a certain scale if you're talking about energy where you actually have to touch real systems, real assets. So maybe Bolong also has some interesting thoughts on this from his experience right now.
Yep. Yeah, no, I mean, so we're currently in the late stage of our fundraise. And indeed, I think, especially at Series A compared to a lot of our seed stage conversations, like one of the main concerns that we hear from quite a bit of VCs is really like that a concern in terms of dilution of or mixing of IRRs, right, between project type of IRRs versus venture scale kind of IRRs. And I think this is one that, quite a bit of the panelists have already brought up. And ultimately, that was one of the early reasons why we chose to really operate in this kind of fully ring-fenced off-balance sheet SPV models, right? So that the two separate pools of capital that as a company we're constantly fundraising from, like, do not mix with each other at all. But yeah, I mean, I think it's also to be said about, in the much longer term, what is the best way to try and scale. Now, however, I think these days we're also starting to see that in the market or in the region, with folks like Lendable, there starts to be quite a bit of debt capital which is coming in, which can be, tenure matching, cash flow matching, even for our project pools, providing quite a nice credit spread on top of which still allows a company to grow without really having to mix in both pools of capital.
Mm-hmm. Okay. Yeah, interesting. So thanks you all. I think the key word here is probably then segmentation between the different pools and also different stages. You'd be going to different investors. And yeah, interesting to understand also how complicated it could get, because each time first fundraising takes time, it is complicated, and indeed then it goes exponentially if you have to do it twice, or even three times in case of Reuben, or even more. Yeah, maybe to jump on the next question that I had, still around the macro side, and basically what's made it possible for you to start these businesses. Maybe I'll turn to the founder again. Is like, what was was there a recent policy change that that most helped you grow your pipeline, and was it then really the policy changes that actually encourage you to take on your business and made you willing to go for what you're doing now? Or was it more a side of the was it more the tech, or is it more market factors that were, let's say, the bigger driver of growth according to you? Maybe Bolong, maybe you can
Yeah, I can share briefly. I mean, for us, the way that we look across different markets in Southeast Asia, when it comes to solar, of course, regulations and policy play a key role. But most of the Southeast Asian governments generally have been quite free market when it comes to residential as well as small scale solar. Instead, conversely, the markets where, at a point in time, there have been very outsized feed-in tariffs, right, or ways to monetize exported solar energy, uh, ended up sometimes stifling the market, right, in the mid to long term. Like Vietnam is a really good example here, which is why Vietnam is also, not immediately in our short-term market expansion roadmaps. However, in the last 1 or 2 years in Malaysia, for example, Malaysia is a really good example to look at, because the government actually introduced over a period of between 3 to 4 months, uh, around 5,000 ringgit subsidy for residential customers to install solar, right? And I think the point of the subsidy was not to necessarily, provide like a long-term subsidy on the cost of solar adoption, but much more really just to spark interest in the market, to drive up conversations and discussions and get neighborhoods through to their initial adoption. What we've noticed thereafter is once the subsidy has went off, despite that fact, customers are still actively talking about solar because they're looking at their neighbors installing solar. They realize that, hey, solar can actually save them a lot of money. And as a result, the market has actually grown really well. In the last 3 years, year on year, the Malaysian residential solar market has been more than doubling, right? It's like 125% CAGR year on year.
Yeah, understood. So you would see that as well, first still a requirement, because there are also the green certificates that were put in place where in Singapore. But then more than a requirement, then it's also a trigger to basically raise the awareness, and then make people also interested in solutions that otherwise might not be.
Yeah, in my opinion,
That's
it's a
interesting.
good catalyst, but it shouldn't be like an outsized, non-sustainable kind of financial incentive. And that's what's the most long-term healthy.
I think maybe I could just add to that. So
Sure.
not a founder, but I guess from the investment side, like one of the things that we look at when we're market mapping, like where should we go next, or like which regulatory environments or like market environments make it easy for companies that we want to look at scale. So I think like for example, like in Indonesia that we talk about a lot about a lot of potential for solar, but like a residential solar there where you have to apply there's a window every 6 months where you can apply to actually do residential solar. So like regulatory there is quite limiting. But if you go to a place like the Philippines where there is net metering. It's quite like advanced in terms of like renewables and like solar regulation. And like there are programs for under 100 kilowatts. Like you can apply for net metering for your household, but it takes 6 to 12 months. Like I think yes, the regulatory helps, but in reality, I think there's like other things that we need to look at as well, where maybe like the typical Philippine household that actually doesn't know that they could actually put solar in their rooftop, or the way like people make payments. So I think one of the things that has unlocked like solar residential in places like Malaysia or Singapore, Vietnam, it's like really this digital payment platforms versus like the Philippines where people still pay with post-dated checks. So it's not just regulatory in terms of that specific like industry, but I think it's like other kind of market factors that make it easy to scale for like certain segments.
Yeah, interesting. Yeah. Thank you for jumping in. Yeah, I see. So more these market factors. So probably tech and maybe technology also going from somewhere else, and also being allowed then to work like digital payments, things like that that then help them to support the technologies elsewhere.
I'll be
Jade,
curious.
I see your
Yeah, sorry. I'll be curious to hear Reuben as well, because on the nature-based solution side, I think regulation is a big piece of what you can and cannot do, especially given the complexity of the involvement of communities. So it would be interesting for me to hear, how do you select your countries?
Yeah, great question. And I think the keyword is exactly complexity. And I've been trying to process what's the most elegant way to answer this question. I think what I would start first is what gets us excited. The what has changed, and in the carbon space, just wait every other day and something changes. But what has changed dramatically in the last couple of years is the emergence of compliance markets. Basically, what that means is countries having imposing carbon taxes or carbon allowances on heavy emitting industries and corporates, and allowing part of that allowance to be offset using carbon credits. And we see that, of course, in Singapore, which was the first one to kick off. We are now, next year, the compliance market is going to kick off in Japan, of which 10% of emissions are going to be allowed to be offset. And of course, we see China, we see South Korea, and many other countries in our part of the world emerging as allowing that to happen. So that gets me extremely excited, because the moment regulations kick in and they stipulate what can be used and what cannot be used in terms of offsets, and that defines a quality metric versus a voluntary market where it's completely voluntary, and the definition of good and bad, is still being worked out. So, and answering Jade's question, that then gives me the lens to prioritize the key markets to look at. So for Japan and Singapore, if I were to use those examples, they literally list out the countries that are allowed to supply nature-based credits into their compliance markets. And with that, I basically focus on those countries where regulation is clear and the methodologies are clear, and even for the project developers, they're happy with that level of transparency. So I'll say one last thing is, it's strange. I previously came from digital banks where regulation was something that we were trying to avoid significantly. But I see now on the flip side that regulation is actually a massive enabler. If you don't know where the goalposts are, it's hard to figure out how to score a goal.
Mhm. Yeah, definitely. So yeah, in that case, you need like the emergence of the more regulation gets more clarity, and then everybody can actually strive to go into that direction, hoping obviously that regulation is also well set up and doesn't lead to a kind of biases and bad situation. On your side, William, is this more like on the energy efficiency side? Is that then more driven by purely cost, or do you have also type of incentives that have been that made basically your business
Sure.
emerge?
So I think for us, it's a mix of policy and private sector considerations. So certainly there are some markets in Southeast Asia where there are more regulations around building energy efficiency, mandatory energy audits. So, Singapore has an Energy Conservation Act. The Philippines has one, I think, from 2021, somewhere around there. And then Malaysia recently passed the Energy Conservation Act, which just took effect from January this year. So that's creating more of a drive for certain types of customers in Malaysia to adopt energy management systems and invest more in those types of solutions, which is something that we're pursuing in the Malaysian market. But still, I think for us, there's a big focus on the private sector sort of client profile. So some large corporates have their own net zero targets and their own commitments, and that tends to be sometimes more important than the local policy environment in a particular country.
All right. Yeah, thanks for adding that. Yeah, definitely understand. I must say that for the businesses we are looking into, often we must concentrate, whether it's concerning energy efficiency, really concentrate on cost effectiveness, obviously, and trying to not see too much on the what should be supported by regulation. But thanks for that. Before jumping to the next part, in which we'll be talking more about the risk return reality and how, let's say, projects and businesses investment are faring into this context. I wanted to remind everyone to post questions on the chat, and we'll come back to that after the discussion. So in around something like 30 minutes. Really, please don't hesitate. Also always more lively, so please go ahead. So yeah, jumping to let's say the second part. Let's start with one that directly involves investors, when they're on the lending side or also on the equity side. We're wondering whether, for the type of business that we are dealing with today, there were due diligence red flags that make you always walk away, even though the IRRs could look nice. And yeah, if you had specific situations you can describe, that would be very, very interesting to know. Maybe Jade, if you have
Yeah, for us, it's stating the obvious, but our highest hurdle is actually business integrity and ENS. So there's a number of businesses we've had to turn down because of lack of proper governance, or some shady situations when it comes to corruption, bribery, and politically exposed people. So again, it's kind of obvious, but for us as a DFI, and having the British government as our only shareholder, we really need to be careful about who we engage with. So yeah, like track record of the counterparty is usually key for us. And yeah, and supply chain issues. So everything, all of the equipment that you procure, making sure that it's traceable and so on and so forth. So yeah, I think this is probably the one thing that people don't necessarily think about when they're in startup mode, or even later on when they are in growth mode. But for us, this is really the biggest hurdle. On the operational side, I think Marga would be able to share more thoughts, and happy to give more insight on due diligence items as well. But yeah, for us as DFI, this would be the biggest ticket item: ENS and business integrity.
Yeah, maybe I can just jump on that. Like, as Jade is saying, I mean, even for us, if you look at the LPs that we have, they tend to be DFIs and like family offices, but like the integrity piece is quite important. And sometimes it's really like KYC, for example, is quite key. And I think it's worth thinking about for founders, like who you put in your cap table could actually affect who you can raise from in your succeeding rounds. Like I've seen examples of companies who get stuck at the seed stage or Series A stage because other investors don't want to go into the same like company because of reputation risks and things like that. I've had to turn down companies because of that, and not so much because we don't like the company, but it's just because of who they've raised funding from. I think on the operational side, for us, like we're a debt lender, so cash is king. It's really understanding how realistic like cash flows are. And are those backed by strong contracts? Like what happens when things go wrong? I mean, I think for a lot of early stage companies, when someone comes to me with a model, it's going to be like best foot forward, not the conservative case. It's just like, so when I go and dig into numbers, I want to make sure that the unit economics make sense. Pipeline matches what's in the model and what is realistic. So for example, like a real example is the number of times I've looked at CNI companies look really promising, but in the 6 months, 12 months time, like the deals kind of go away, and that's because they've not been able to convert on their pipeline. So it's really like digging into the fundamentals of the company and making sure we understand where cash is coming from and how realistic those projections are, and like do they have the team and operations in place to actually execute on those like plans.
Yeah, and on the equity side, so that's not sharing as BI per se, but from experience dealing with founders, one of you like a good founder that's very ambitious and that has a lot of vision, but I think there's also a downside where if a company isn't really able to focus and deliver the core business proposal, it could be an issue, when people are talking about adjacencies before they have a core business. That sometimes is something that I wouldn't look favorably upon. Yeah.
Yeah, making sure, ensuring that cash flows can be delivered, being wary about the promises made. Obviously, I understand, and then part of that also is that for any of the business being in energy efficiency, in solar, or probably in carbon credits, is like, okay, what's the business and what are the cash flows? What's the quality of the earnings at the end? Maybe so then to turn to the founders, I was wondering, yeah, how you're protecting, and if you're protecting your cash flows then against these customer potential default, or whether in the case of a nature-based business, like carbon prices swing will have a big impact. Are there ways and what strategies you could put in place to overcome that or to avoid?
Happy to jump in since you mentioned carbon nature base, and I'm probably the only one on the panel.
Yeah.
A couple of things, and it's such a good point, particularly for long gestation projects. So on the project development and measurement component, any milestone-based payments, we ask for 50% upfront. Basically, 50% would cover the cost of any out-of-pocket expenses. And then, we make sure that with that, our downside is capped. And then the remaining 50% we collect it upon deliverable. That basically protects us. On the carbon prices, that is a bit harder to hedge. But the good thing is that we're not terribly exposed to that. We take 10% cut of carbon credits as a part of the payments, and for us, because our costs are already covered, that part contributes to the profit, and we are less sensitive to that part. And of course, we want to maintain our profits as much as possible. But I feel like at this point, if we can make sure that we cover our costs and we're not out of pocket, that is a good hedge for us.
Yeah, indeed. Okay, so keeping that as the upside, and then protecting your downside in that way. Okay, interesting. On maybe William's side, would you have some insights for us on how you're managing that client's risk?
This is definitely something that we're very focused on, is understanding the customer profile and the risk profile of that customer. So are they a multinational corporation? Are they a local small business? And that's going to influence the kinds of payment terms that we offer. For many of the projects, we also look for a deposit upfront. As Reuben mentioned, we need to kind of cover our downside when we're especially sourcing equipment or supplying equipment. But now that we're looking more at OpEx-based subscription models, we are looking at things like potentially insuring contracts if the deal size is large enough. We're also looking at doing a more thorough due diligence on, especially outside of Singapore, some of the clients that we're approaching for this kind of model. But I don't think there's really an easy answer. I think you just have to have a very comprehensive sort of due diligence process for your customers.
Yeah, I think maybe just to add on briefly, like from our observations within the solar space, I think what Reuben has mentioned in terms of setting up all the processes to make sure that each step is de-risked, right? Customer risk profile, the ease of making payments. But I think beyond that, one of the really interesting things is also like in quite a bit of the technologies that are operated within the space. For solar, for instance, we also ensure that all our monthly leases to customers are naturally already lower than the electricity bill savings for customers, right? So, for instance, in a scenario where a customer chooses not to pay, a remote shut off of the system is extremely punitive. And then this, even just from a psychological perspective, beyond all that credit assessment, will also naturally help drive incentive alignment for customers to want to continue to pay up. Yeah, on the carbon pricing side, we deal with renewable energy certificates as well. One thing to add on is also like while prices can be volatile, one of the things that we're starting to do is to sign, 5 to 8 year forward contracts with some buyers that we've traditionally been selling to. Because while on our end we want that visibility, actually there are quite a lot of buyers who also want to make sure that they are hedging, right, from any kind of long-term spikes in terms of prices. So that is a way to also mitigate that risk.
Okay, yeah, thanks, Bolong. So I hear from you and William. So yeah, different sources as well. So insurance and due deal, obviously, and then sometimes also looking at how you can structure your revenues or what are the levels you want to reach to be sure that basically all your costs are already covered and let's say the default would only impact your upside when you're at the other, protecting thereby your business, and then some hedges you can take as well. Well, thanks for that. I wanted to jump to another question that was already mentioned previously, and it's would be directed to everyone here, and basically it's what's your take on the asset light versus asset heavy models in solar or energy efficiency, and according to you, which would be the ones that would scale better, and how is it perceived? How is it usually perceived by the market? So if you get some feedbacks from either investors or either from companies on where they wanted to go, and for that maybe who would want
You can
to
start
take it
because I
first,
have the
maybe?
most basic opinion, and then it would be good to hear the operational side of things. So I think the asset light versus asset heavy model to me really comes down again to know your audience, like who's your audience, who are you going to raise from, right? If you're talking to, again, like VC firms who want a large multiple in a short amount of time, they won't really want, I would think they won't really want to have this asset heavy exposure that's going to take, I don't know, in the best case 3-4 years, in the worst case 10 years to pay back, right? If you're talking to people who have more of an infra, again, in the energy efficiency solar space or even NBS space, people who have more of an infra mindset, they won't really understand what are you doing if you're not putting actual stuff on the ground, right? So to me, it comes down to know your audience and tailor your product based on it. And I think there are differences in terms of achievable returns and achievable pace of scale, but also magnitude of scale. Those are two different trajectories to follow. But again, it depends what is your DNA, what is your investor's DNA. Everyone around the room had probably interesting stories to tell around asset light versus asset heavy. So I'll be looking forward to hearing those thoughts.
I can share a bit from experience. I mean, so when we first started structuring or launching rent-to-own solar models for residential customers, this was first in 2022, and at a point in time, we're basically the first in Southeast Asia to do so. And And that contributed to a very big part of why we structured like an off-balance sheet or asset-light model, right? Because there were risks that we wanted to try and ring fence out, right? Also, of course, I think at the very, very early stages, we were a bit worried that, or also, just observationally, it's very difficult to take in, say, debt, right, at a small ticket size to be able to scale on a so-called asset heavy or on balance sheet kind of model. VCs like that a lot also, right? Because our revenue profiles are basically like software as a service like. However, I think these days we are quite actively thinking about, that transition to debt, right? And I do actually believe there is kind of a middle ground between that. Oftentimes where for instance, at this point in time, all our solar assets in Singapore are generally doing like a mid-teens type of unlevered IRR, right? One of the main downsides of being asset light we notice is that we don't have as much control or ownership to be able to capture that credit spread, right? The excess returns, we're leaving quite a bit of money on the table. We are unable to say like, easily sell off portfolios or start to like refinance portfolios because they're not equity owned by us. But at the same time, we're starting to see that there's actually quite a bit of debt which is available in the market where, interest rates are, of course, significantly lower than project IRRs, right? Where tenures can also be as long as the tenures of which we're operating, which is 5-year or 10-year rent-to-own solar assets. And I think the other then remaining concern that some VCs might have is that, okay, if you want to try and scale up debt, right, ultimately there are some debt equity ratios to abide by, and hence at a point in time you might need to start to deploy a bit of that capital that I'm investing in you, and hence then your total IRRs might not be as attractive from a VC perspective. However, for instance, at this point in time, like there's maybe about a 30 to 50% share of our projects where customers are also paying a certain down payment amount, right? And that kind of customer payments can also be used to offset a sizable chunk of that equity co-investment into project portfolios. And I think that can be a way to, still ensure that capital pools are kept separate while a company starts to move into like a asset heavy, so-called asset heavy business model.
And I think maybe I'll just add to that. I think it's really like a structuring question. It really depends on the company and like what the service is, right? So for example, if you look at, I know it's solar energy efficiency and NBS, but I'm just going to take an example, for example, from e-mobility, where let's say you have cars, charging infrastructure, and those have different kind of return expectations. So whether you want to like maintain manufacturing or you want to, what do you call this? Just buy cars from someone else and have like a sale lease back with someone so that you have management of a fleet. That's one way of structuring it so that it's asset light, but then you own a battery charging infrastructure. So I think it's really like understanding, or I guess it's also like a graduation of like different stages of a company. If you are at a certain scale and maybe you have like different asset classes within your company, maybe splitting some of it out, some of it in-house, some of it off balance sheet. To try and like match what kind of funding is available for like certain asset types. So for example, like a corporate PPA versus like a residential like solar asset. Maybe a corporate PPA, if you like have the assets on balance sheet, or you can ring fence it as a project finance like structure, that's easy to do. There's like more finance available for that. For like residential solar, if you're starting out, maybe it's fine to have it on balance sheet if you only have, let's say, 50 like projects on your book. But at some point when you have 6 scale, could you then maybe package that and securitize it, put a bunch of assets that are similar in behavior and performance together so that you can actually like unlock alternative forms of funding. So I think it's really, one is a stage question. I think two is really a structuring question, like what makes sense to keep on balance sheet versus off balance sheet, so that you can actually unlock like other sources of funding. And I think the third piece is really like what capabilities do you have in your team and understanding like what is core, non-core to my business so that if I'm a solar selling, let's say solar residential like product, am I an EPC? Am I a developer? Or am I the funder? Or am I the portfolio manager? Like all of those could be like different roles, so like different returns. So you don't have to be all of that. So I think it's understanding like where you play in that kind of value chain.
Maybe I'll chime in with a different view on this, just so that we can have a debate. And obviously, as a startup in this space, we think about this a lot. Everyone likes an asset light business, and but at the same time, it's hard. And why is it hard? I think fundamentally, to for climate tech, it is still pretty much a brick and mortar or atoms type of business, because it requires a fundamental retooling of the entire economy, and you cannot do that purely on a software. And at the same time, because it's so early on in the cycle of this business, that um, there aren't enough ways to apply software yet, because we're still at the picks and shovels side of the cycle. And maybe, a few years from now, where if we stick to the solar or renewable energy theme, maybe if there is a greater contribution of renewables as a percentage of the entire energy mix, then software could come in to optimize the mix, to help to manage pricing, to help to manage supply and demand, to avoid things that happen like what we saw in Spain, where you have extreme volatility in prices. That could come in, but that requires first for the hardware, all the atoms to be in place before the electrons can do their optimization. And it feels to me that we're not at that part yet, and most certainly not within nature. The other lens to reframe that is, whilst asset light gives you higher returns, it may not necessarily at this point give you in terms of the absolute amount of value, because of the value chain at the moment, where the bulk of the value, I think, will be captured through the companies managing the atoms, so to speak. And if they focus entirely on software, then and the asset like piece, then you're not going to be able to tap that huge economic part of the model. And so, the way that I try to tackle it is, as I highlighted earlier, the idea of having two parts of the capital stack: one that is more infrastructure-like returns, and then the other one which is more asset-light type returns, and then try to pair that capital to the returns, so that it becomes a lot more congruent.
Thanks, Reuben. Yeah, so from your intervention and then Marga's intervention, I understand there is so basically a tension between to decide for one or the other is like the tension between the core and non-core activities, then between aggregation, which sometimes is favored for people who want to raise more money, they want to aggregate more, etc., versus segmentation, because the business might be different in different parts. And then the last tension I see is between, do you want to achieve what is seemingly higher returns, but then captures less of the value. And then, depending and let's say assessing on these dimension should help to see whether you should go for more asset light or asset heavy. And maybe the question and the answers could provide a good segue also to our next part, which will be more about creative financing opportunities. And so what we can think of for, let's say, new structures, new things that we can bring in, so that more decarbonization projects, more businesses and green businesses can see the daylight and strive basically and scale. So maybe on the investor side, so maybe for Jade and Marga and well, founders don't hesitate to jump in this case. Do you see innovative financing structures that you would like to see implemented, or do you see new tech coming in as being enablers for more capital being allocated to projects?
Yeah, I can go first. So again, it depends what you're calling innovative, but something we haven't seen so much in the market maybe yet. I think what Lendable is doing is quite important for the evolution of the markets here, where we need to see more debt going at the smaller scale, and whether it's supporting VC-backed firms and companies. The availability of debt to create first of a kind factories or smaller scale project. That's something that I think will enable a lot more to be financed and to be built, because again, like VC minded equity people who are looking for asset light kind of projects, it's not a good match for sometimes what needs to be built in the 3D world, right? More on the DFI and BII side, we are really very actively in the trenches of putting into place blended finance structures, whereby maybe at a larger scale, but you have a junior tranche and sometimes mezzanine tranche, senior tranche, blended into financing vehicles, so climate finance vehicles. There's a lot of activity in fund managers around the world right now to try to unlock that capital. And BII, we have recently launched a mobilization competition where one of the key metrics that we're looking at before backing a GP these days is how much money are we going to be able to mobilize from the private sector. So that matching different pools of capital, I mean, it's not new per se, but I think there's a lot more energy behind that these days, and people are really trying to wrap their head around that. Maybe the last piece, again, from this perspective of BII and how we're trying to move the market. I think there's a lot of things that is happening at the grassroots level with, again, like small ticket sizes. And the question is, how do you bring it to scale, right? So how do you create like a market level kind of an impact where it's not a drop in the ocean where you're going to create like one or two projects here, but you're really going to be able to channel larger chunks of money towards those projects, make it bankable, make it scalable. And here, I think the roles of, there's different pools of investors for different stages, but one key element for doing that is obviously like the tech stack that enables you to standardize and scale. So I think if I'm not wrong, Get Solar has IT or software capabilities that are able to systematize project approvals, and I think that's quite key for them to be able to aggregate projects fast and bring investors that wouldn't be able to look at a sub 1 million check, for instance. So those are the key enablers that come to my mind. But I'm sure Marga would be able to tell more from the lending perspective.
Yeah, I think for us, and maybe just taking a step out, at least like for us at Lendable, I think what makes us different as a lender, apart from like us like going into these like younger, earlier segments, and maybe being able to do like a smaller ticket size. I think for us, it's really we're a data-driven platform. So we started with fintech, and now we're launching into decarbonization. And it's really to the extent that we could use some of that data across like different geographies and like different segments. The more we do transactions of a similar type, the more we will be able to like standardize like, okay, these are the red flags, these are the covenants that we would need to put into a debt agreement, and these are the types of like default rates, returns that we could expect from a type of project, or like of a typical, let's say, residential solar project or typical energy efficiency projects. I think right now, like there's not enough information, I guess, and like it's a lot of siloed thinking in terms of at least on the investor side, this is my deal. I don't want to share like more info, but I think the more that we could kind of work together and exchange notes on like what works, what are the return expectations for this like specific kind of asset class, I think it helps like unlock more of that funding, because at least we can tailor products that match like the stage of the companies that we have. I think in terms of like innovative financing structures, if anything, for us at the earlier stage, we actually want to try and keep things simple. So it's more like, how do we introduce like a plain vanilla loan, or how do we introduce project financing to a 2.5 or 5 million million dollar like transaction? So it's introducing the same types of products that would be available for a 15 million, 20 million dollar deal, and bringing it to that earlier stage, so that it's almost like a stepping stone for projects or companies in clean tech, the earlier stage ones. Like if they borrow money from us, for example, they can then go to a local bank in like 2 years, 3 years time and say, I know how to manage a project finance transaction. I know how to manage like a traditional loan. And I can show you what our repayments look like with this lender that we have. So it's being able to kind of de-risk it for institutional lenders who are probably sitting at like larger ticket sizes. I think there needs to be a more like, I guess, complete, at least on the debt side. Like there's venture debt, there's us at like, let's say 2.5 to 15. There's like other funds at 10 to 15 mil. Then there's the banks, and making sure we have the different products that are right for the different stages, but you can't like not have like gaps in that, because otherwise then a lot of the Southeast Asia ecosystem is still quite young. So there has to be enough like working capital loans, 3 to 5 years, small ticket sizes, so that the 10 million, $50 million funds have actually something to invest in, because this is not enough. So you kind of have to grow with where the market is.
Yeah, I think just to, oh,
Thanks,
sorry.
Relmy. Go ahead.
I think ticket size is a really important issue, especially in the energy efficiency space, where the project sizes are typically, even under $1 million potentially for, an equipment replacement. So for us, we're looking at aggregation opportunities, but that means that we would have to support projects initially off balance sheet and then look to finance perhaps later on once we hit a certain critical mass. So I think there's definitely a need for lenders that are willing to go to smaller ticket sizes and support the kinds of projects that we see, especially in still a very early stage market, so that companies can grow to a scale where you can tap into those deeper pockets.
Yeah, I totally agree from observations. I think operationally, what I notice of quite a few of the challenges that some founders in this space face is like at the early stage, where they're still unable to maybe structure something off balance sheet successfully. They may end up taking up debt capital, which is of a shorter tenure, which may not be in conjunction with the cash flow in their projects. And then that ends up creating a large strain, right? Or for folks who don't want to take that kind of, shorter term, 1 to 2 years type debt capital, which is a lot more available in the market, then they struggle to get to that 10 mil, 15 mil kind of ticket sizes to unlock the longer term kind of project financing or infrastructure type debt capital to scale.
But I think maybe I could just add to this. I think there's also the flip side, because there's innovative financing structures, but I think there's also just more innovation in terms of like business models. So I think, for example, energy efficiency is an interesting one, where in the past, right, like the options available if you want to update or upgrade your HVAC or cooling system or a cold storage facility is basically you just go to the supplier and then hope for the best that they give you good payment terms. But then if you have like as a service kind of models that look more like CNI kind of or commercial industrial like solar contracts, it one hopefully helps like the customer, you give them a different kind of payment plan, but two, it's a structure that funders are familiar with from another segment. So like lessons that you can apply, or like the way we look at like metrics from those types of projects, like could we apply it to like other segments just because the business model now looks similar.
Yeah, thank you. Thank you for adding that. So yeah, I understand. So in general, the need for capital at all stages, and that's the importance of it. Seems that currently Southeast Asia, small tickets and maybe earlier stage companies seem to be underserved, and so maybe there we could see there is a gap. One way to solve this would be to kind of pull on previous experience or type of financing experience that financiers or lenders or investors have seen in other industries and try to replicate or translate in a for more of a, let's say, energy efficiency business, solar, nature-based, and other upcoming businesses. I think we are gradually running out of time, so I wanted to take maybe one or two questions before we have to close the chat. So I don't know if there are questions in the chat. So,
Yeah, there was a question for me, so I can address that. Plus, it's a nice segue into what we just talked about.
Great, thanks, Jade.
Yeah, so there was a question about what kind of track record or metrics do you need to see before backing energy efficiency or nature-based assets in the region? I think for nature-based, the answer is quite clear. It's not yet in our mandate for Southeast Asia. It is in India and Africa for BRI. Mainly is the nascency of the market in the region and like the lack of clarity in the regulation for the last 5 years. So we run in 5-year strategy period. So it might be included in the next one, but it's not yet confirmed at this time. And for energy efficiency, it does fall into our mandate. Here, what we see is that for any kind of business, again, it's an issue of scale for direct investment. So I should have mentioned before, but BI, we have direct investment and intermediated investments where we are LPs into funds. For direct investments, given that we have quite a large check that was given to us by the British government for Southeast Asia, 500 million pounds to invest within 5 years, 2022 to 2026. It was, 2027 initially. It's a bit challenging for us, let's say 20 or 25 million for direct investment. How we circumvent that is going through our funds. So I did mention that we were invested in a few VC funds here in the region, and what we do usually is that we co-invest with them for smaller tickets, let's say 5 to 10. So for direct investment, I would say that the biggest challenge or the biggest metric would be the track record and the number, the amount that is actually investable for us. And for indirect investment, I think I could turn the question around to William because he was invested by one of our investees, CSF. So what stage was your company in when you were, just recently able to attract funding from CSF?
Sure. So, yeah, it's an interesting question. Our company, when we were going through the due diligence and going through the fundraising process, I think there was a lot of focus on just sort of financial fundamentals. So looking at our gross margins, looking at how close we were to break even, looking at year-on-year revenue growth. So I think there was a preference for companies that could be profitable, say within 2 years, if the scale is sufficient, which is different than what the VC mindset has been for the last several years, right? Where it's more about your top line growth. And then I think it was important for investors to see traction in multiple markets, where you're not just limited to say Singapore or perhaps one other market, but you need to be able to really scale regionally. So I think those are the things that we've seen come up a lot in conversations with investors.
Thanks, Reuben, and thanks, Jade, for your answers. Maybe we jump to the next question from the audience, and then we'll have to wrap it up because we are already running out of time. So, given the diversity across SEA countries, which markets are leading in integrating these asset classes, and what lessons can be transferred regionally? Who's in?
I think Marga made a good point earlier, so about the transferability of business models. Do you want to say more on that?
I think I wouldn't say there's like a leader, but I think certain regulatory environments or market environments make it a little easier to do certain things. So like I would say like Bolong, for example, in Malaysia, or in the Philippines for like residential solar, like the regulatory environment and like maybe the just the development of like the EPCs, like they know how to do like a solar rooftop project. And so it's just being able to like take the contract, or how do you like reach then your customers and things like that. So it's the technology is known. We know what the risks are, but it's really more like around the business model and then how do you actually capture like your target markets. Um, but I think the other piece is really around like what could be learned around how do you contract? How do you go to market? What makes sense in specific countries? I think maybe I'll take an example of carbon is an interesting one where I think a lot of us who are able to look at carbon projects, it's really like understanding like who the buyers are. Are these like blue chip? Um, what are the quality like are these like quality credits, like what are the reputational risks? So I think like we look at things with a similar lens, but there are like certain like markets where it's just a little easier to do things because of the regulatory environment or like market kind of landscape. I That's not a really good answer, but like I think it's quite country dependent, and I think it's one of the things that people don't understand with Southeast Asia is like each country is actually quite different. It's hard to say there's a model that is one size fits all.
Sorry, I put you on the spot. Yeah.
I think it's absolutely true that it depends on the asset and it is very different in each country. And so that's one of the challenges that all of us, I think, are facing on the founder side is figuring out what works in each country and how you need to approach the market in each country. So yeah, I don't know that there's an easy answer. I think in our case, we might be a little bit better off in the sense that we're more of a sort of platform horizontal business, and then we can cover multiple verticals. So if we go into a certain market, we can assess, do we want to focus on the manufacturing sector? Do we want to focus on commercial real estate? Do we want to focus on maybe renewables and DERs? So that helps us a little bit to tailor our go-to-market for the local conditions, but you still have to do a lot of discovery and kind of figure out the right strategy for each market.
All right, thank you. Thank you everyone for this very insightful conversation and discussion. I hope everybody in the audience has the same opinion as me on that, and that everybody could learn about how businesses and investors are navigating in this environment, and also what should come next to enable the decarbonization of our economies. I'd invite everyone to check the pages and applications that we've made, and obviously don't hesitate to connect and participate in this industry, obviously. Thanks everyone, and I think we can close it here.
Thank you so much.
Awesome. Thanks, everyone.
Thank you.